Okay.
Yeah, it's all set.
Perfect. Hello, how are you doing?
Very well.
Nice to see you.
Nice to see you.
Thanks for coming. So this will be a lot of people that we saw at the Startup Cup, yeah? Startup Cup? No. No? Not the... Never interviewed at Startup Cup?
Me. That's right.
You were... You guys were at the Startup Cup, yeah.
Yes.
We were talking about your business today. Yes. You mentioned that. I think you guys need to do a collaboration.
Sounds like a plan. Carlos.
And pinch point.
Pinch point.
Yeah. Pinch point. Because they're game. Oh, the game. Yeah.
Hi.
Hi, how are you?
Fine.
Nice to see you. Mohammed had the psychotherapist. Yeah. Nice to meet you.
We have a startup called Cutlet.
Called what?
Cutlet means to print.
Oh, I saw it there. Yes.
Providing psychotherapy psychotherapists.
That's very smart.
So here at Pakistan, we have a very big stigma associated.
Yeah.
Because
You want to
therapists,
go. You want to go, yeah.
yeah, because they might teach
Right.
people that
Right. Paid service?
yeah.
Yeah, paid. And are there real therapists on the other?
Yeah.
So everybody has a degree and
Yeah,
like
we
normal.
have a therapist, 13 therapists, also provide sessions.
Very cool. Very, very cool. That's a good idea. Everybody, stay tuned. Yeah.
Should I use a mic? Wow, that's really loud.
Hi guys. Alright guys, are we ready? Can you all hear me? Can we get started? Okay, so today I'm very, very happy to welcome Sharon Amezcua. And I think we actually announced her as Sharon Clayton, so I'm sorry, I apologize for this. Sharon Amezcua, her husband is actually in the back, Carlos. Sharon has been here for a few days, helping many of you out already. So I just want to give a very brief bio and introduction. She is extremely, extremely impressive, and I really hope that all of you will benefit from her talk today. So Sharon has over 29 years of experience working at the intersection of industry, technology, and finance. She started her career after graduating from the University of Florida as a private banker at the First National Bank of Atlanta. After that, she went to become the sales manager of Marriott Hotels, then followed as a sales engineer at Johnson Controls, which is a heating, ventilation, and AC company. She did several things with them, including running their investment firm. Is it their investment firm? Global Financial Services Industry. Then she left and started her own business, advisory company called Presentations. There, she advised some of the largest electricity companies in North America on building their deregulated industries. Energy services subsidiaries, I'm sorry. She then went to found New Energy Ventures, which became the largest deregulated energy services company in the U.S., reaching $1.1 billion in revenue. Then she left them and founded a merchant bank, a boutique merchant bank called Moore Clayton & Company, where she would take companies from startup and to $1 billion where they exited. So the way the merchant company worked is they provided strategic advisory services to the company, invested with them, and then basically led them to that exit, which is an incredible model. After building and investing in hundreds of companies through that company, that it was finally listed in the Frankfurt Stock Exchange, so she moved to become chairman of the management board after that. She is currently the co-founder of ESE Partners, a future financial services company that builds and invests in emerging and established companies in targeted sectors around the world. She is also CEO of JDF Film Fund and Junto Box Films, which has patented technology for sourcing and funding micro-budget films. And that's it. She's married to Carlos who lives in Malibu. So,
That's the most important part.
yeah, I think you can talk much better about your background, but thank you so much for being here.
Thank you. Thank you for having me. Welcome everybody. This is going to be interactive. I'm not going to speak at you, so please ask questions anywhere along the way. And if I lose my train of thought, it's because I'm old. So excuse me. But I thought today we would go through, in these training sessions, they asked us to kind of pick an expertise where we thought we might be able to give you the most assistance and information. And so I looked at the list and I said, well, we kind of do a multiplicity of things, but I think investment is probably one of the most necessary parts of startup companies and of growing companies. And I think it's probably the toughest part, and it's actually the part that most people dislike the most. I certainly have not cared for it much in my background either, but it's something, it's a necessary evil. We have to do it. So, if so, let's figure out the best way, the most efficient way, the most effective way, and let's figure out who the right investors are for the right deals. Because you can find a lot of bad money for good deals, and you can find a lot of good money for bad deals. And I think that many of you have experienced all of the above. So there's not a lack of money out there. It's finding where it is, and it's putting it with the right deals, and it's leading the deals to the money. And before I kind of start the whole thought process behind it, I'll tell you one of the things that is lacking in the marketplace is the ability for investors to find good deals. And we're working on a technology platform right now in LA that is from smart technical people in this area of the world that happen to live in LA, and we are putting a business together to begin matching or doing a dating game between investors and deals. So eventually we will come down to the startup level. We're starting at the hedge fund level, at the private equity fund level, because that's where accredited investors are used to investing. They're not afraid of those deals, so we're matching those first, and then we'll bring it eventually down to early stage startups. So it's one thing I've seen in my sort of 30-year career that is really lacking. It's one of the reasons I had to get on a plane every other day and be in a different country every other day, because I had to find the right deals with the right investors and the right investors with the right deals. And that's what I spent most of my career doing in building businesses. So raise your hand here if you are an investor. We've got one investor in the room. Everybody remember who it is. Okay, raise your hand if you have an early stage company. A startup, an early stage. Okay, anybody have a mid-stage or growth company? Okay, and anybody have a later stage company that you're ready to exit? Okay, good. That helps me understand who's in the room and where sort of I need to focus on what the thought process is. My understanding is you guys, some of you guys in the room have been the beneficiaries of some of the seed capital that comes from the programs that are here. How many have been a beneficiary of those funds? Good. And also you're getting a lot of the services, I understand, that go along with that, which is great. I think one of the best things that we've been able to do in the building of businesses around the world is to build accelerators. And we started saying accelerators before anybody else did, by the way. Everybody was calling them incubators. But we were really truly accelerating companies, and we wanted to always do that hand-holding process that is what helps accelerate the companies, not just giving them money, not just giving them space, not just giving them lawyers and IT guys and HR people, but it's really truly holding hands and doing it together. So that's my philosophy, and I thought I would start out by kind of talking about different types of investors, and if I'm making it too simple for you, please raise your hand and say we get all this, or if I'm making it too difficult and there's a word or something that you don't understand, just say, don't understand that word, I'm sorry, I don't speak Arabic, I wish I did, but since I'm speaking in English and it may be a second language or third language for some of you, then please just stop me, okay? I won't be offended if I'm speaking too quickly, just stop me. But, you know, I kind of classify investors in these pots. You have angel or high net worth individuals. Does everybody understand that terminology? High net worth individuals? Okay. There's another classification that many of you may know, which is now called ultra high net worth individuals. Anybody know any ultra high net worth individuals? Once they get past $1 billion, we give them a little different classification. They act like institutions. They can basically invest like a bank can. You know, writing $1 million checks, multi-million-dollar checks doesn't phase them, doesn't hurt their pocket. It's like these guys writing a $100,000 check. Okay, so ultra high net worths are somebody that I've spent a lot of time with around the world, because after they've made their money in industries, oil and gas industry, wherever, they tend to like to begin to play in the private equity arena. Everybody understand private equity as a classification? Okay, so most of us are playing in the private equity arena with our startups, our mid-stage companies, our late-stage companies. Unless you've taken them to a public market, they are classified as private equity. You probably all know that. So you have high net worth individuals, and then you really get into institutional money. And institutional money is basically governed by rules and regulations, typically. More rules and regulations. An individual that writes a check has their own rules and regulations. They just have to deal with the tax guy if you're in a place where they have to deal with their own taxes. Not for you to worry about, but for them to worry about. In the institutional arena, you'll see all of the funds. So venture capital funds. Now a lot of angel groups have funds, but they act more like institutions than individual angels. So you have to be aware of that difference. So even angel funds will act a bit institutionally, okay? And then you have private equity funds. And you have investment banks. Or corporate finance houses. Everybody understand what all of these are? Does anybody not understand what Okay, corporate finance house. They're usually, you find them all over the world, and in fact, interestingly enough, I saw them pop up in the Gulf region when I was living and working in the Arabian Gulf region. They weren't there so much at the beginning. But they're typically, they start out, corporate finance is about the structuring of finance in either public or private equities. So how does the deal look? How does it get structured? But corporate finance houses also have licenses to raise money. So like broker-dealers in the US, which is licensed raising of funds, FSA or SFA regulations in the UK are licensed raising of funds. Those are usually classified as corporate finance houses that have fundraising licenses. So not only can they structure what your deal should look like, they also can raise the money for you. But they are typically licensed to that and pretty regulated. Okay? We were able to take our SFA license from London and use that all down through Europe and the Gulf. So we didn't have to be separately licensed as a corporate finance house. So when I had my larger merchant bank, we did all of the above. And that was what made us really different. And so when I was drawing the needs of each of the stages of a company, if you start with early stage companies, it's usually better to have this money or this money, because you're looking for smaller amounts of money, and you're looking for money that won't stop you from doing what you need to do to grow the business. And usually at the beginning it's called what? Bootstrapping, right? You have to do what you have to do. And so you need people that kind of get that and can, what I call, hang out with you, so that they, are not really boxing you into some, what I call hand-tying paperwork, that doesn't sometimes allow you to do what you need to do. Now, I know we have a friend in the back who has a fund, and so forgive me, I'm not speaking negatively about this, but in the early stage, as you know, you may have too many tight parameters for companies. They can't do what they need to do. So we wait until we grow the value of this company, until the company grows to a bigger value. And then we're able to go get more institutional money because we're able to validate a valuation. You know, at the beginning, valuations are like this, right? You know, what does it feel like today? What does the air feel like on my finger? You know, okay, that's what our value is. Now, there are many ways to value companies. Is everybody familiar with valuation methodologies?
I brought you another one.
Oh, good.
I saw
Okay.
you're running out of room.
Oh, good, good, good.
You want to do it?
Yeah, perfect, perfect. Does anybody know what the typical institutional ways of valuing companies are that are done across the board? Okay, so you have what they call DCFs, discounted cash flows. Anybody ever heard of that? Okay, discounted cash flows. These are traditional institutional ways to value companies, okay? You have a multiple of revenues, and you have a multiple of EBIT. Everybody know what EBIT is? Earnings before interest and taxes. Everybody understand that? Sometimes it's called EBITDA, earnings before interest and taxes and depreciation. Okay? So a multiple of revenues would mean that you multiply the top line revenues and you get a valuation. A multiple of EBIT means you take your EBIT number and you multiply it times a certain amount of times in that industry that are standards. So these two look at industry standards. So say, for instance, you have a healthcare company. You look at the healthcare companies that have been sold in the industry, and you see what multiple of revenues did they sell for, or what multiple of EBIT did they sell for. And that's what you call your multiple. That's how you would create, or a fund would look at your valuation, okay? If you have cash flow in your company, which early stage companies do not, they will look at the cash flows and they will put a 10%, a 15%, and a 20%, and sometimes greater discounts on those cash flows. So they will assume that your forecasting needs to be discounted because you might not be right, right? So that's discounted cash flows, okay? Then you just have, these are the standards. Then you have early stage companies which may not have any cash flows, they may not have any revenues, and they certainly don't have any EBIT, right? So how do we value a company? For an early stage investor or a later stage investor? How many people know? How did you, who raised their hand that you've gotten some early stage money from here? How was your company valued?
Actually, we didn't evaluate the company, so what we expect, what we argue.
How did you decide what percentage the money would take?
We didn't.
You haven't done that. Has anybody done that in this room yet? Anybody given a certain percentage of their company in equity for a certain amount of money?
I mean, we've done that.
Yes?
It was a package. 20,000 for 8%. That's it.
Okay.
So by default, the companies were evaluated at 120.
Right. Good. There you go. So that's a formula, obviously, that the startups have come up, or that the organization has come up with here, that they've used to say this is a standard, and many incubators and accelerators do that. They say, we're going to give you a certain amount of services, and for that we want this percent. We're going to only give you, X amount of dollars, and therefore it puts a valuation on your company. Now, there's good and bad in that, okay? Because once a valuation has been struck on a company, you need to make sure it goes up before you get more money, or else you have what's called a down round, right? So if somebody has invested in your company at $250K, if that's the valuation they put on it, then it better be at $251K before you put any more money in, right? Or else the people that invested here are going to lose value in what they invested. So my big piece of advice for everybody looking for money is, number one, do everything you can possibly do prior to taking the first money And that means have a business plan. I know some investors believe in business plans and some do not, but everybody wants to see at least a 10-slide presentation, right? And we'll go over what those 10 slides should look like that every single investor wants to hear. Okay? Have at least a business plan. Understand what your needs are. Your needs. Okay? Don't pretend like you don't have to pay rent. Don't pretend like you don't have to pay your car payment. Understand what your needs are, what the needs are for you to take that 3-month period and build that business properly so that that 250 can become 251 plus. Okay? So you have to understand your needs when you go out to build a company and try to value your company. So if your business plan is such that you understand your needs and also the expenses of the company that it will take to build it, and minimize those. You want to, in the very, very, very beginning of the company, you want to minimize those as much as you can. Get people that are working for you to take options. Yourself, if you can possibly, after you consider what your specific needs are, if you can possibly work without taking a lot of cash, you want to preserve as much cash as you can possibly preserve to get it to the next level. So get a business plan, get your understanding, get as much IP developed with your own resources without going out to anybody else to start with. The more you have and get a team developed. Even if you can't hire people, get people to write to you to say, I will come on your team as soon as you get your first funding. Okay? Go out and get advisors that say, I will come on your advisory board if you get your company funded. Then you can take those and you can use those for building the value of going to get your first cash, right? If I have a company and I say, I'm the only person, but I've got this brilliant CTO that's going to come in with me as soon as I get my first 50 grand, here's his resume, here's his letter of intent to come with me, then I have more value, right? If I have value in bringing somebody from my sector onto my advisory board before I start the company and I say, this is my mentor and advisor who is coming on the advisory board, he's built this company, this company, this company, this sector, I'm going to have more value, right? If I have a full-on business plan, if I truly understand my needs, because what investors don't want to see is they don't want to see you say, oh, it's only going to cost me 10 grand a month, and then it costs you actually 20 grand a month to live. That's why I said understand your needs really clearly. So many people underestimate what the needs are. At the same time, your needs have to be realistic. You have this balance, right? So that's kind of how we look at, investors really look at valuation and how they make a decision on really, and you make a decision about where you're going based on where you are in your company. We have one mid-stage deal here. If you're a little bit further along the path, then maybe you have some of these things established where you have a real valuation and go out and talk to some institutional players and be able to defend that valuation and get what you want versus what they might want to give you. You understand? So in the earlier stage, though, it's you building this case to talk to these people about why your valuation should be a certain thing. The more you know, the more you create in terms of value for yourself, going out to talk to people, the better deal you're going to get. Now let's talk about types of money. Does anybody have any questions about this? Anybody have any questions? Go ahead. Somebody, go ahead. Okay. I want to talk about structured deals. You know, we talked about corporate finance houses and how they structure your finance for you. And everybody understands the difference between finance and accounting, right? Okay. So finance is actually capitalizing your company, the financing you need to grow your company. Accounting is the accounting of your business, all right? So to differentiate, if you're looking at the financial structure, I always back into this, and I think it's really important to teach people how to back into where you want to be. I was talking to Pinch Point today about this. So if in the end your goal is, again, this has to do with your business plan, right? My goal is to build a gaming company to to create some of the top games in the world and sell to EA or somebody big, right? So at the end, when I sell to EA, do I want to still be in control when I sell to them? Do I want to have something so big that I stay in control and I do a merger with them as opposed to a trade sale? Or am I willing to dilute, everybody understand the word dilute? Dilute down to 10% for my business to now be owned 90% by somebody else who's going to make that, my 10% worth 10 times more or 100 times more or 1,000 times more. So you have to figure out where you want to end up. And I always ask people, and I probably asked people in this room, where do you want to be? What do you want to do with this company? Do you want to just build it for dividends and sustainability? You need to be really clear with investors about that. Depending on who your investors are, they may want to stay in with you and hang out with you and just have a viable business that keeps generating jobs and cash flow and everybody shares in the dividends. But you need to know if that's the way they think. Okay? Because if it's a fund, the majority of the times an institutional fund, they have to get a return on investment in their fund to raise their next fund. So they've got to figure out who they want to invest in based on what it is you want to do as a company, right? So if your goal is to just give dividends, that's one thing. If your goal is to do a trade sale, selling to someone in your industry, to do an M&A deal where you merge with someone where you may have majority or you may not afterwards, or to do an IPO or a reverse merger. Does anybody know what a reverse merger is?
Split? Company?
Reverse merger is, they use the same terminology. A reverse split is the same terminology with stocks, but a reverse merger means there's already an existing shell company sitting in any exchange anywhere, and the business that was in that shell company did not work out so well. So you can actually use that publicly listed shell to reverse your company into, which gives you, first of all, it costs a lot less to do it, and it gets you there a lot faster than doing a full-blown IPO. So I put that up there. You need to really know what you're doing when you do these, and obviously a lot of investment banks here will understand these very well. But it just gives you another option, a public option. So these take your company public, these keep it private typically. Okay? So in looking at where you want to end up, you then come back to, okay, here's 100%. How much do I want to own when one of these things happens? What's my goal? If I want to end up with 10% of a $1 billion company, sorry, I'm talking in dollars too, not shekels. I think all of you guys are used to that. 10% of a $1 billion company, then that's what my whole business plan has to move towards. Okay, I never have to state these, but state these numbers. I'm just asking you to think about this in your own mind. Or do I want 50% of a $100 million company that maybe does an M&A deal with somebody, and I maintain 51%, and I go along, and I'm really only going to build a $100 million business, Where is it that I want to play? Or do I want to maintain 51+% of maybe a $10 million business, because I don't want to take much of the institutional money. I want to use as little capital as I possibly can, and I want to maintain control. I just want to build a $10 million company, and then maybe one day I'll sell it, or I'll take it public, or I'll just have to. And you can be anywhere along the spectrum. You can say, I want to own 51% of a $1 billion company. You might be the right entrepreneur to take it to that. You also have to recognize early on, are you the team that can take it to this, or this? And know where you can play, okay? Because investors want to know that too, and they'll ask you that. Are you the guy or the girl that can take it to $100 million? Is it a $100 million company? Tell me why it's a $100 million company. Tell me why it's a $1 billion company. Are you the team that can take it there, or should you sell it at some point? Okay, so these are all things to consider when you're writing your plan. Where do you want to be along that spectrum? And I'll show you why. So, if a cap chart looks like this, does everybody know what a cap chart is? Capitalization chart? Who owns all the shares in the company, okay? If somebody asks you for your cap chart, investors will, you need to know what your cap chart is. Really important. I find most entrepreneurs do not have a really tight hold on their cap chart. It's something you as business owners have to manage consistently, okay? Or else it can kind of be managed out from under you by lawyers and, you know, etc. You need to know what you're doing. So a cap chart, let me go back over to this board. Anybody have any questions, or is it helping?
Yes.
Is it helping you understand? And at the end, if I miss anything, you ask me what it is, where the holes are, because I just kind of been talking along. But so your cap chart, and let's call it what it is. It's a capitalization chart. Shows every single shareholder and every single option holder. Everybody know the difference between shares and options? Okay, shares you're actually defining today. I've given you shares for equity or for debt. Options are a future opportunity to turn them into shares, okay? So you can give people, you can incentivize your people with some shares and some options. The reason you do that is you price shares at today's price. You might want to price options at a future price to give people the desire to help you build it to that price. You help me, Mr. Whoever's coming to work with me, you help me get it from $5 to $10, I'll give you another 5% in options at $10. So now raise the value of the company. If you help me get from this milestone to this milestone, because then we can bring more money in at a higher valuation, right? Everybody get that? So options are another way to incentivize people without giving up 100% shares and equity today. You can also see how they perform, right? You can also put a price on them that's higher than today's shares, such that they could even be an investor by buying those options at that higher price. Now, if they help you get the company to a higher price than the options, then the options for them are what we call in the money, or they're free. So you understand that? So they help you take the company from $5 a share to $10 a share, then they don't have to pay for those options because they've gotten you to the price of the shares. They then convert those to shares because that's the deal you've had with them. So when I say all shares and all option holders are listed, it's the difference between what we call dilution and full dilution. So if you're looking at somebody's cap chart and they say, is your cap chart fully showing your full dilution? That means do you have the option holders on there as well? Just so you're clear, okay? So we'll have this, it will have the share price, so it'll have the shareholder or option holder. It'll have the share price or option price, and really you should put an option price separately here. And then it'll have the total outstanding amount of shares, right? Because everybody wants to know what percentage they have, and then it'll show the percentage that each person owns, right? Now, this is equity. So you need to really keep a tight hold on this chart if you're a business owner. Because it has everything in the world to do with how you raise your money, how you structure the financing of your deals, and etc. So if you understand where you want, what you want this to look like when you're ready to go to a transaction or sell the company or take it public or do something with it for everybody to make equity worth something, then you will be able to make decisions a lot more easily when you go looking for money. You'll be able to figure out who best to talk to, how best to talk to them, and you will be able to lead the conversation saying, you know, right now my shareholders look like this, my cap chart looks like that, I have these outstanding options, my share price is at this price, and then you're in the driver's seat. See, understanding this stuff is so critical for raising finance. That's why I'm going through it. If you don't understand this stuff, you're on the back foot, and people are telling you what they want, at what price, and what the valuation of your company is, right? So just one of the biggest parts of raising finance that people don't understand is they have to clearly get what value they have achieved in their company, okay? Looking at IP, looking at team, you know, if you're talking about, if you don't have revenues, you don't have EBIT, you don't have discounted cash flows, you don't have hard assets. What do you have? What have you built? What have you created? How do you build value in that? And then of course you look at comparables in the market just like you do when you're looking at real estate. So, okay, it's another gaming company that started like we did. They had 1 game, we have 2 games. They were valued at this when they took their money in. We think we should be valued at that. You're always looking at comparables in the marketplace, right? And you guys have a small marketplace here now, so it's pretty easy for you to do that. You know who's been funded, right? You know who is out there getting funding, not getting funding, and why. So it's great for you where you are today. When you start playing in a bigger market for investors, you need to compare. If you're looking at money in Silicon Valley, you need to compare your company to what's being funded in Silicon Valley. And I've heard many of you talking about that, so you are doing that. It's good. So all that to say, where do you want to end up? What are you willing to give up? Here's my standard for startups, and I'll just, having built over 500 startup companies over the long period of time, it pretty much always works, but I'm generalizing. And everybody knows that there are always exceptions to the generalization rules, right? So don't take this verbatim, but just think through this when you're evaluating your own company. I always take it and say, okay, I want my founders, if they're the right founding team, the right people, I want them to remain at 51% as long as possible. I want them to have control as long as possible. Okay? I want about 25% to go to the team that comes after the founders, eventually, the whole team, the built-out team I'm talking about when it's time to do something here in a transaction. And I want about 25% to go to the money. That's the way I look at companies, okay? Now that is if you, this is the optimal way to develop companies. That's if you have done all the things I said that you needed to do in terms of enhancing value before going out to raise money again, enhancing value before going out to raise money again, enhancing value before going out to raise. It's a repeatable, scalable thing that you have to continue to do. This is doable, but you have to really manage the process with investors, okay? Don't let the investors manage you. And I'm saying that from an investment standpoint because I like walking in and people saying to me, here's what we've done, here's how we've done it, here's what we want, here's why we want it, here's what we're going to do with it. Okay? Boom, 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 boom. And then I can ask some questions and I can find holes in those, or maybe not. Maybe they've actually done all their homework. So the more questions I ask as an investor, the lower the valuation goes. If you can give me a presentation, which I'm going to go through in a minute, that covers all the gaps and all the holes and answers all the questions before I can ask them, then your valuation stays up there, okay? That is a standard with investors. If you walk in and they start asking you, and some people just like to hear themselves talk as well, but if they're asking you, the more questions you can eliminate by your presentation covering everything they need to hear to make it a more secure opportunity for them and a more exciting opportunity for them, the greater your valuation is going to stay during those discussions. The more they can, shoot holes in what you're talking about, the lower your valuation goes in their minds, right? So this is where I like to play. So I like to say to companies, if they come to me, I say, okay, I want you guys to maintain control because I think you're good guys. I think you're capable of taking it to at least this level, if not higher, right? So if you believe that, then I'll try to help my founders because I like them. And I've been a serial entrepreneur, so I don't want anybody to know the majority of my company, right? So I'm going to help. That's what we do. We help people. And then I'm going to say, all right, you need to be generous with your team. You need to take care of your team. Tell me who your team's going to be, when they're going to come in terms of milestones. When are you going to hire the CTO? When are you going to hire the CFO? When are you going to hire the next level of MDs, whoever they are, salespeople, business development people. Tell me what your plan is. Because you need to reserve a certain pot for those people because you're not going to be able to pay them market rates, and you shouldn't be paying market rates in an early stage company, okay? Incentivized by equity, and then everybody's on the same page. Everybody's working together to make it worth something, but you have to take care of people, especially people that are taking care of you by not taking a market salary, right? Then you've got to take care of the money, but you want to be as much in control of taking care of the money as you can. So the money is very happy to be here as long as they believe the value of the company is what you say it is. So you're building your case for the value of the company, and then you're going out to the money. Now, does everybody understand how valuation and dilution works? So if you, for instance, gone out and you've gotten that first, let's say 50 grand for 10%, okay? It still leaves you another 15% to play with. But if you enhance the valuation after that 50K has gone in, say you put the 50K in at $250,000 valuation, now you've enhanced the value to 300K. That dilutes to a smaller number, but it's worth more, right? So everybody's happy. So you still, some people when they first start looking at these percentages, they go, but wait a minute, I don't have 10% anymore, so therefore, my value, I want 10% of your company. And you say, okay, well then you need to re-up and invest again at $300,000 valuation.
So buys got bigger. The pie's got bigger.
That's right, the pie has gotten bigger. So as you move up on valuation, this percentage for the investors moves down, but it's worth more. If they want to keep a certain percentage, they have to invest more money at the higher valuation, right? Because now you're taking investors in at a higher valuation, and they can come in what's called pari passu at the same level, right? So that's the key way to manage this. If you keep that in your mind, and you may come in and your first investor says, I want 25% because you're asking maybe for 100 grand and your company's only worth 3 times that, right? Because they're wanting to take a quarter. So you have to be very, very careful to manage this. Whatever that number is, I'm giving you my standard, which I help, and we will help. We'll continue to help you guys do. Okay, and just, if any of you call and ask for help, this is what I'll help you try to balance. But people are generally at the early stage in the angel arena. They're not looking to take much more than that. I mean, some, but again, then you have to weigh, are those people you want to work with that want to take 40, 50% of your company? That doesn't leave room for you to do anything for your employees, doesn't leave room for you to do anything for anybody else, and you're kind of stuck. So you really want to, get that first stage money, get that business plan together, get that research together. We heard you talk about the amazing amount of research you've done, which really helps you in talking to your investors, right? They thought you were extremely thorough, and they said, okay, he's done his homework. So, does anybody have any questions about this?
The early stage investors have any say on later stage investors? Like, can they?
Yes.
If the later stage investor is valuing the company lower or something like that, does that early stage investor have a say?
Yes. So this is the key that I told you about, this concentric circular model that I always live by. If you are keeping your valuation here, you need to stay at that angel, friends and family, buddy realm, so you can say, look, it's not quite going, like, could you put another 10 in maybe, or another 20 in and help me get to this, and then they're not going to mess with you too much because they're friends and family, they're people you know, etc. If you get to that next level and you don't know those people very well, and it's maybe somebody the angels gave to you, you're going to have to really have enhanced valuation with milestones that are measurable, that they can actually see, to be able to negotiate at that level, okay? And then when you get to institutional money, you absolutely have to be able to meet the criteria that are their parameters. Every single time you talk to a VC, a private equity fund, you need to know what their parameters are before you go talk to them. Because I can tell you, you also need to read documents that they have used with other people, because there are a lot of things that they do to tie your hands from raising more money from individuals once you've raised money from institutions. So you have to be really, really careful that you understand all those parameters to keep, to really stay on top of it. And again, a lot of it is watching your cap chart, watching what the parameters are, having really, really good legal advice tell you, do you understand if you take this money it will preclude you raising money from any other source unless they get first right of refusal. There are things like that that are in documents which you have to be really aware of when you go to the institutional arena. And the reason they have to do that is because it's not their money, whereas the angels, it's their money, they can do whatever they want. It's somebody else's money they're managing and they're promising a return to. And therefore, they have to tie you down to certain things to ensure they get those returns for their investors. So it's not because they're being ugly. They have the bigger pots of capital. But in order for you to fit into those, you need to understand them. Okay? So just be clear, when it's time to go to institutional money, you need to know what the value of your business is. You need to know your financials backwards. You need to know your business model in your sleep, okay? And how to tell the story about your business model. I think I talked to a group, I think it was you who we were talking to, and I said, when you tell your story, make sure you tell it, if this, then this. If this, then this. If this, then this. And people can understand you are telling a story about how your business makes money. If they can understand it in a logical progression, then they'll think the numbers are real. If they're all over the board, or I think I'm going to get revenues of X, because I'm going to do Y, and then Z, the Z answer is way over here. No, I'm going to do it because of X, Y, Z, and it makes sense. As they listen, they can hear the story, and the story makes sense to them, right? So I wanted to go through with you the best presentations that will keep investors quiet, which is what your goal is, okay? Keep them as quiet as possible. So I always look for, the first thing is, what is going on in the marketplace that creates the opportunity first. It's got to be clear. Okay? What's going on in the marketplace that creates the opportunity? What's the problem that creates the opportunity for solution? Boom. Simple, right? If you don't say that off the bat, people get really confused about why you're doing what you're doing. It's just because you like gaming? Is it just because is there a need in the marketplace that you're filling, right? People will get it if you talk like that. Okay? Then, what are the needs or target market or niche within that opportunity that you're fulfilling, that you're going to go after, okay? Now you've set up, oh, anybody can do this. In their minds, this is big. If you've said these three things appropriately, it's not about you yet. It's about anybody out there. They're going, oh, that is a huge problem. Somebody needs to create a solution. And by the way, I get what the needs are in this specific niche. Now you just set them up, because now you're going to go, boom, this is what I'm doing, all right? So then you say, here's my business, and you can state it in a vision, but here's your product or service, and here's what it does, okay? Here's what we're doing. They don't even have to do anything in their minds, right? They've gone, oh my gosh, it's a huge problem. Oh my gosh, somebody's going to solve it. And there's a specific need for honing it down to what you're going to do to solve that problem, right? So then you say, I'm in the blah blah business, and here's what I'm going to do with it. Simple. It's your elevator pitch, right? Somebody asks you in the elevator, what do you do? That better be what you hear. Because you've got 5 minutes, it might be a big time investor, and they go, I'm interested in that industry, let's talk, right? Then you look for differentiation. Everybody know what that word means? How are you different than everybody else, right? It's better be clear on the next slide, right? Because then you're going to go, well, it isn't so doing that, and so it's such and such, and okay. And then how do you approach the market? Okay, that's your marketing sales plan. Okay, if you think you're different, then how are you going to get this to market? Then we look at competition. And what has to go with competition? A clearly sustainable competitive advantage. So when you write a chart and it shows everybody else is playing in this industry, the name along the top better be yours and it better be have every box checked. You're the only one that can do all of the things that need to be done to fulfill that need in the marketplace and create that solution, right? Otherwise, they're going to give you a whole lot of chat about, well, there's so-and-so in the market, they're doing this, there's so-and-so in the market. How do you compete against so-and-so? Tell me about this. How do you know about this? You know, what have you done about these guys? Okay? Sustainable competitive advantages and differentiation creates what? Barriers to entry. How are you going to keep other people from doing this before it's time for you to sell it for 100 million? Okay? That has to be clear. How many investors have asked you, what are the barriers to entry to this, right? And how have you created such high barriers to entry that nobody can come in and compete against you before you're ready to sell it?
Like patents and copyrights.
Yeah, exactly. There's copyrights, lots of ways you can create. You know, if you suddenly go out and grab the market and you've got 1 million unique users in a month, you probably have a bit of a barrier. How'd you get those users, you know? You've got time now to continue building. So it can be many things. You can create barriers in many, many ways. Okay, and then they're going to want to know your business model. Everybody know what the word business model means? It's that story, right? What's the story? How do you make money? We do this, that, does that, and creates profitability in this way, right? So, be clear. Here's how we make money. Don't put a bunch of financials up there. Here's how we make money. If you want to know, how do we make money? Okay? And then how do you sustain profitability? That's a really, really, really important question because your margins have to be so sustainable that it's a viable business for the long term. You might be able to get margins of X right now, but what happens if those barriers to entry don't stay high and it all of a sudden becomes commoditized? That's not that interesting for investors. They want to see the margins go up or stay stable. They don't want to see them pushed down by commoditization, right, of your product or service or whatever you're doing. So what's the business model? And then financials. Summary financials, okay? What's the most important thing about the financials? Yeah. What?
Operational cost and net profit.
Investment. Assumptions are the most important thing about the financial model. You can write all the numbers you want on the summary forecast, but unless you are clear about what your story is and your assumptions, we have assumed, you told me the story today, we have assumed that we have this many investments, they can do this many things in this day, that they, you told a great story. It's a great story. Couldn't really tell, but you told a great story, it stumped me, right? I couldn't answer any more questions. So, your assumptions are your story. But your assumptions, what are these financials based on? That's what people are interested in. They want to see if they're real. Is that realistic? Then anybody can do the math and put the, multiply it times whatever and put it in an accounting spreadsheet, right? You better make sure those are right too, because people do check things. But the most important thing is the assumptions. Okay? And then last but not least, so critical, who in the world is involved with this company? And what are their credentials? And that includes advisory board and management team, potential management team. Who do you have that says they're going to come in and do this with you if you do meet certain milestones, okay? Advisory boards, I can't even say enough about them. I have one in every company I've ever built because they are your friends or your father's friends or your mother's friends or your friends' friends who've done it before. You want them around you. They're your mentors. it would be helpful if they can also write checks because they help you with this next little level of funding, right? But if you put an advisory board together, they can't make decisions for your business, but they can help you make decisions for your business. They can't stop you. You want to keep your board as small as possible. You don't want many people on your board because you want to be able to make decisions quickly if you're the right entrepreneur, right? So that's it. If you answer all this, how many slides? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Oops, it's 11. Make it 10. Okay?
I'm gonna take a picture of
Go
this.
ahead. I didn't write it very nicely. I could write all this stuff for you and send it to you. But anyway, that's basically it. That's all I know about investing. So that's what I've done for the last 30 years, and this is the way I've done it. Repeat it every single time, do it the exact same way. It's really that simple. I know it's honing it down to a tight little message. And our friend that was with the fund left, so I hope I didn't tick him off. Good. No, institutional money is just different. You need to be ready for it. People need to understand it because so many people think VC funds are the way to go, and that's great, but you better be ready for that level because that is a level where they know what they're doing, you know? And a lot of angels, like I said, now act like funds because they've come together to use each other's knowledge. And I should tell you that one of the important things to understand about angels and other investors, institutions as well, critical to understand about angels because they could become, great advisory board members for you, is what is their vertical market expertise? What is their horizontal business expertise? I'll explain what that is. And what is their geographical location and expertise? Really important that you know these things about your investors, okay? Because if they don't know anything about investing in Palestine, probably aren't going to be realistic about what you're trying to get them to invest in. Just FYI, okay? There might be new people that want to come here, but you're going to have to do some teaching first. You understand, this is our market. This is what we're here doing. We're learning about the market. We don't know about the market. We're learning, okay? What's your horizontal business expertise? So go ahead.
What's the difference between vertical market and
Horizontal. That's where I'm going. Okay, vertical markets are industries. Okay, healthcare, media, entertainment, energy, the sectors. Vertical market sectors, you can call them many different things. Industry sectors. Horizontal businesses are anything that go through all those sectors. So if it's technology in general, could be software, could be hardware, could be a legal expertise. It could be accounting, it could be IT, whatever it is. As long as it would go through any of those, it doesn't care. These people that know these things typically don't mind what sector they play in. They're more generalist with what they know. Here, if you've got a healthcare expert, angel investor I'm talking about, or even a fund that invests mostly in healthcare technologies, and you're talking to them about a delivery business, they might not be the right guys for you because they might be basing everything on what they know in this sector. So always look at what the vertical market expertise are of your potential investors, all the horizontal business expertise. Ask them what their background is, what they've invested in, what they know, what they prefer, where they've built businesses, where they've run businesses. Because then you also know, especially at that second level, when it's time for you to go out and get strategic partners for your business, you can call those guys and go, hey, since you ran Cisco, I'd really like to tap your relationships for my tech company, that I really want to sell to Cisco at some point, right? So if you know that about them, it's really important. You can ask them as many questions as they ask you. So you need to know that, and then you need to know where they've played before, where they've lived before, what they know about those areas, so that they can also help you when it comes time to sell your product outside of Palestine into the Gulf region, into Europe, into America. Who is it that knows somebody that can help you get there? Okay? That's really, really, really important. Really important. Not only for you to focus your business on a vertical market, a horizontal business, and a geographic expertise and play at these intersections. Play where you know things, okay? But also investors play where they know things. Understand that when you're talking to them. Okay? Anybody have any questions?
I might have a question about evaluating the startup, which is much more important. Is it whenever evaluating, let's say, a startup, established one, is it much more? Is it important to have a built product and already sold in the market, or they look at like the potential business more, which is much more?
Depends on what you're raising. So if you, I always tell people, and the first question I ask is, how much have you put into the business? Now, you might not have hard cash because you might be 19 or 20. You might not have made any money yet. But if you put in sweat equity, you can calculate that into your own investment. I have gone without a salary for X, Y, Z. I've lived at my parents' house. All the things people do to start a company. So all of those go into what you have done. If you decide that you have enough money from your parents or whomever to go ahead and write whatever it is, the software or build the hardware, if it's a product or if it's a service, whatever it is, then you're going to get a higher valuation. It's going to lengthen the amount of time until you need investments. At the same time, you've got to measure it. How far can you go into developing that without having outside capital? And if you're
It's already developed.
if it's already developed,
Yeah, without any, let's say, investments. I mean,
fantastic, fantastic. You take the platform to the marketplace, and if it's just an asset, by the way, people will value companies on assets. It's just that early stage companies don't usually have many assets, but assets are another way to value companies. What do you have on your balance sheet as an asset? If you have IP, intellectual property that you created, whether it's hardware, software, whatever it is, it doesn't have to be patented. Patents, of course, give you a little more. But in this day and age, most people aren't patenting things as much anymore. Just so you know, that's the sort of trend, is that not as much in the software arena or the high-tech arena is that happening, because people are just getting out there, blowing it out, turning around, selling the company for $1 billion before patent can even be granted, So in your case, taking a platform to the market to then get funding, you're in a great position if you have a finished platform. You're in a great position to say.
It will help evaluating the.
Absolutely. If you actually have an asset that you created, you will have. I should go back and tell you one more thing about structure. We were getting ready to talk about it, and I didn't tell you. There are equity deals, which everybody knows about. People put in money, they get shares, right? Or they could get shares and options. Then there are, let me do debt deals next. Then there are debt deals. You borrow them, you have to pay it back, right? Then there are convertible debt deals. Anybody done one of these? Convertible debt deals are great if you've got people with the appetite to do them. Convertible debt are great for both sides because you don't have to dilute your equity holding to take them in, but you do have a debt on the books until it is converted to equity. The wonderful thing about that is if you take debt or convertible debt, you don't have to put a price or a valuation on the company. So if you're thinking, okay, with this 50 grand, I'm going to get the company from $100,000 valuation to $1 million valuation, then you don't want to take that 50 grand because you're going to give 50% of your company away to take that 50 grand today. If you take it as a convertible debt deal and you have a milestone that you agree with the investor that says, we're going to convert that to equity as soon as I get the platform finished, and it meets these criteria, then you're going to have $1 million valuation, and that little 50K is going to give them a lot less stuff. At the same time, you do a deal where you say on the convertible debt, it has a coupon. Everybody know what a coupon is? An interest rate. Has an interest rate of, say, 8%. That's high. But you can read anything. Payable annually. So therefore, you're not paying that on a monthly basis. They're allowing you that time to get that value up. And they can even say, we'll roll that into equity when we convert. So it's a win-win for everybody. If they believe you're going to meet that milestone, they'll do that convertible debt deal. Now, you might not give them what's called a sweetener, because they came in so early and you have raised the valuation so much with their 50K, you might say, you know what, just to be fair to you, because we built so much value with your 50K, I'll give you double the amount of shares, or the amount of shares plus an amount of options. You can always, if they convert, I'll give you an equal amount of shares, or I'll give you 50% of the shares. I'll give you the number of shares you bought and another 50% of the shares, or another 50% of the options. Whatever. You can always, it's up to you. Again, as long as you control your cap chart and you control your company, you can do these things. So you have options. And the more value you build and the smarter you are about managing when you take money in, who you take it from, and how you structure it, the more value your company's going to have and the more you're going to stay in control. You just have to be knowledgeable about these things. That's the key thing, is learning. Somebody, did you have a question?
I was asking about convertible debt, if you can explain it again.
Yes.
And what the difference between equity and debt?
Okay, so equity, somebody comes in, gives you money, says, like they do here, $20,000 for 8% of your company. Equity deal. They've taken equity in your company. The debt deal, they come, they give you a loan, they say you need to pay it back by this date and at this interest rate. Convertible debt, they say, and this is a fairly new thing. We've been doing it on the West Coast for a long time, but now it's kind of spread around the world. But just so you understand, it's an option. And not options like I was talking about before. It is a choice. That's a better word. Convertible debt is debt today that has the option, has the choice of converting into equity. Now, not to get too complicated, but you can write the paperwork such that it is at your choice, if they will sign that, or such that it is at their choice, which they typically will sign. Okay, but there are deals out there where it says, at my choice, because I might not want you as an equity holder, I might want to pay you back that money, okay? So they believe in you enough and you've got a hot enough deal, somebody will sign that deal with you. But convertible debt means it can be converted into equity.
So just to make sure the terminology is right in my head, convertible debt is the same as convertible notes?
Convertible notes, yes, same. Should have said that, yeah. Thank you.
And what's royalty?
Pardon?
Royalties.
Royalties, I didn't talk about royalties, I should have, yes. You can finance, and it happens a lot in the biotech arena. If anybody's ever done a biotech deal or a life sciences deal, there are royalties where you can do a royalty deal and basically finance your company based on future royalties, okay? So, or licensing royalties. If you've structured your company that you're going to have a franchise, you're going to license them, and you can do deals that will allow you to do royalty financing. But it's kind of like financing on cash flows too, which, by the way, banks will still do. So few startup companies have the option of doing that, though, because so few startup companies have actual orders, revenues, etc. And I think you have to be a pretty sophisticated investor to invest on a royalty deal. I've seen it at University of Florida in biotech deals, and I've seen it in other life sciences deals, but not in a lot of some software deals, yeah. Good question though. Anybody else?
Maybe I didn't get the part of options.
Okay. So let me go back and explain. So, by the way, a lot of this has to do with where the investor is from, where the money is coming from and whether they have a tax issue, what their tax treatment is in their country. That is another thing you need to understand when you're talking to investors. That's why you have to understand the geography. Where are they from? You know, do they have a tax implication in your country for investing if there is a loss or a gain? You need to know that. You need to, it's not your job. You just need to make them aware that you understand investing in this country if there's a gain. They need to get their own tax advice. It's not up to you to give them tax advice, but I'm just telling you that there can be tax implications for certain ways that you structure things for investors. And you need to be aware of that. So, say you want to give somebody 10% in shares. They do a convertible, well, they wouldn't do a convertible debt because it wouldn't be in shares. But they've done an equity deal and they bought 10% of your company. They're bringing so much value. They've taken you to your first client. They've brought your first investors in. They've brought you a great board member. They've, you know, whatever. You might just say, instead of paying them cash, instead of paying them a percentage on, you know, what they brought to you, like percentage of revenues or whatever, which could harm your business in the end, you might say, I'll give you 5% options. Say the shares were bought at $5 per share. Okay? I'll give you 5% options. You can incentivize them at $10 a share. Okay? So you're not giving them options at today's price, you're giving them options at a later price so that they will help you get to that value. And then say, I can give you these options if you'll do these 3 things for me. And you better know that all 3 of those things get you up to that value. Okay?
So basically it's like an incentive to make them work harder so that they're getting the percentage of it.
And it's an incentive for your people. If you have 25% of your company that you can give away, right? And you're giving maybe 10% to the CEO and maybe 5% to the CFO, whatever, you know, but you've got only maybe another 10% left for the rest, and you want to incentivize these guys a little bit more, but you kind of need to reserve that to the rest of your team. Then you can say, okay, I've given you 10% in shares, but I can also give you another 2% in options at a higher valuation, because then, as you know from valuation discussion and dilution discussion, your company's going to be worth more, so it doesn't matter if they have a smaller piece, right? And then they can get an extra incentive when it's worth more.
And you can keep the shares.
Exactly, and you keep the shares good. Okay? Everybody get it? Yeah? Does that help? Anybody want to know anything else that I know? Or that I don't know? I'll find somebody else. Who knows?
So what do you know?
What do I know? Gosh, so close. It's not even funny. My brain gets smaller every year. I lose information. Go ahead.
Have you ever seen it, or do you know any resources where that can help our entrepreneurs value their company at an early stage? Like maybe things that they can put in, like their time, and like you said, you know, I lived at my parents' house for a year. All of that. To monetize it in some way.
I challenge every early stage entrepreneur to value what it is they put into the company if it's not cash.
Right.
I think it's really, really important to talk to investors about that. You know, if you have not put in cash, you don't have cash to put in, but you have had cost avoidance, right? So these are things that show me, when I'm talking to people that I'm interested in investing in, shows me that they have the wherewithal to do whatever it takes to make this company work even without capital. And that's what it tells you. It doesn't necessarily, when you're valuing it for your value, it's telling them about who you are and about what the costs really are associated with the business. Because see, if you put together financials based on the cost of the last 6 months and you haven't taken a salary and you haven't had, you know, any other cost and you've been able to work for zero, then it's not the real cost of the company. You have to know, that's what I said, know what your costs are, so that it's not, you're not trying to say all these good things to investors to get them to invest, and then the reality is you can't live like that. So there are 2 different things. There's what have you put in that has helped to build the value of the company to date, Then there's the value of the company that has been built to date because you have given up all your fun with your friends and, et cetera, and living in that, fabulous apartment instead of staying with mom and dad's, So there are two kind of different things. There's understanding what the value of you have contributed, and then that contributes to building the value of the company because you've been able to take that time without capital.
What about the value of IP? Like you said, if there's something you've already developed, how do you evaluate that?
Really hard, but can be done. All early stage companies are like this, and to this date, they're still like that. There's nobody that's figured out a real methodology. Everybody uses pretty much the same thing. If you've had a round, this is what people say about private equity companies, privately held companies. The company is either worth what you raise money at the last round or what you currently have a term sheet out for. This is if you're raising money, okay? If you have a term sheet out that someone has signed to say, I will invest at $100 million valuation, that is a validation of your valuation. If you have not had capital go in since your last round, which was at $15 million in the company, then that is typically your valuation once you've raised money. If you have never raised money, then, and by the way, on top of that, you add